When people think of startup funding, their minds often jump straight to venture capital. The images are of pitch decks, Sandhill Road, and billion-dollar valuations. But the reality is that venture capital funds only a tiny fraction of businesses, and not every great company fits the criteria or the aggressive timelines that VCs demand. For many founders, alternative funding paths, bootstrapping, crowdfunding, grants, and other creative options are more aligned with their vision, their growth strategy, and their personal goals. Alternative funding isn't about lowering ambition, it's about broadening choices. It's about finding capital in ways that preserve control, align incentives, and match the pace of your business. By exploring these options, entrepreneurs unlock more flexibility and, in some cases, create more durable, founder friendly companies. There are three major reasons why founders should think beyond traditional venture capital. The first is being not VC ready. Many strong businesses simply don't fit the VC model. Venture firms look for exponential growth, massive total addressable markets, and exit potential within 7 to 10 years. But plenty of successful startups grow steadily, serve niche audiences, or prioritize sustainability over speed. These companies might never attract VC interest, but they can thrive with alternative funding. The second is the ability to maintain control. Venture capital comes with strings attached. Investors expect board seats, influence over strategy, and eventually an exit. Alternative funding allows founders to keep ownership, preserve decision making authority, and steer their company in line with their own vision, not an investor's mandate. The third is flexible growth. VC funding often pushes companies into hypergrowth whether or not the market is ready. Alternative funding allows founders to scale at their own pace. Without the pressure of aggressive targets or looming exit deadlines, companies can focus on building strong fundamentals and sustainable unit economics. In short, alternative funding is not about avoiding growth, it's about choosing growth on your own terms. Bootstrapping is the oldest and simplest funding model, building your company with your own resources. It starts small and grows through discipline, reinvestment, and relentless focus on profitability. The first principle is start small. Founders often launch with personal savings, credit, or small loans. The goal isn't to build everything at once, but to create a minimum viable product that tests the idea and attracts early customers. The second principle is reinvest revenue. Instead of chasing external capital, bootstrap companies plow early profits back into operations. Each customer funds the next stage of growth. This creates a cycle of organic scaling that rewards efficiency. The third principle is scale strategically. Bootstrapped founders focus on profitability and operational excellence from day one. Without outside funding, discipline isn't optional, it's survival. This forces better decisions and creates stronger long-term businesses. The benefits are profound. Bootstrap founders retain 100% ownership, make decisions quickly, and control their destiny. Success stories like MailChimp and Basecamp show that even tech companies can achieve massive valuations without venture capital. MailChimp grew for 20 years before selling to Intuit for $12 billion, entirely bootstrapped. Bootstrapping proves that funding scarcity can be a strength. It creates resilient, customer-focused companies that live and die by the value they deliver. Crowdfunding is another alternative path, raising small amounts of money from large groups of people, often customers themselves. It comes in two primary forms. The first is reward-based crowdfunding. Platforms like Kickstarter and Indiegogo allow customers to pre-order products, effectively funding development while validating market demand. This approach is particularly effective for consumer products, creative projects, and innovations that spark public imagination. The second is equity based crowdfunding. Platforms like Republic and Seed Invest allow anyone to invest small amounts in exchange for actual ownership stakes. This democratizes investing and lets startups raise capital from hundreds or thousands of micro investors. The power of crowdfunding is twofold. It raises capital and validates demand at the same time. When customers are willing to fund your development directly, you have immediate proof of market fit. Crowdfunding also creates early advocates, people who don't just buy your product, but actively promote it. For entrepreneurs, crowdfunding turns funding into a marketing channel. It's not just about dollars raised, it's about building a community that believes in your vision. Grants and non dilutive funding are another powerful tool for entrepreneurs, especially in research heavy or mission driven fields. Unlike equity investment, grants provide capital without requiring you to give up ownership. The first source is government programs. In the United States, SBIR and STTR grants provide up to $1.7 million for startups developing innovative technologies. These programs support early stage research and development, making them a lifeline for deep tech and biotech ventures. The second source is foundation support. Private foundations and nonprofits often provide grants for startups addressing social, environmental, or healthcare challenges. These grants are mission aligned and reward impact as much as financial return. The third feature is the no equity cost. Grants allow founders to retain 100% ownership while accessing critical funding. The trade off is fierce competition and heavy paperwork. Applications can be complex, timelines long, and reporting requirements strict. Grants are best suited for deep tech, healthcare, sustainability, and research heavy startups, sectors where early development costs are high, timelines are long, and traditional investors may be hesitant. For the right kind of company, grants are a lifeline, money without dilution, enabling breakthroughs that otherwise might never get off the ground. Real world examples illustrate the power of alternative funding. Oculus Rift began with a Kickstarter campaign that raised $2.4 million. This not only funded early development, but also validated global demand for virtual reality. That momentum helped attract investors and eventually led to a $2 billion acquisition by Facebook. MailChimp is perhaps the ultimate bootstrapping story. For 20 years, the founders grew without a penny of venture capital. By focusing relentlessly on customers and profitability, they built a company serving 14 million users and eventually sold to Intuit for $12 billion. Biotech startups frequently rely on SBIR grants and research funding to survive early stage development. These grants allow them to fund long, expensive R&D cycles before turning to private investors. Without grants, many life sciences companies simply couldn't survive the valley of death between idea and commercialization. The lesson is clear. Alternative funding is not second tier. It's often the smartest path, whether through scrappy bootstrapping, community-powered crowdfunding, or mission-driven grants. These models prove there are many ways to build great companies. The key is alignment. Choose the funding path that fits your business model, your timeline, and your personal goals, not just the one that seems trendy or impressive. Alternative funding is about choice. It's about recognizing that venture capital is not the only way, or even the best way for many entrepreneurs. Bootstrapping rewards discipline and ownership. Crowdfunding builds capital and community simultaneously. Grants provide non dilutive lifelines for mission driven or research heavy startups. Each model carries its own benefits and trade offs, but all of them create opportunities to grow without surrendering control. The success stories of Oculus Rift, MailChimp, and biotech startups remind us that innovation doesn't need permission from VCs. It can thrive with creativity, community, and commitment. The ultimate takeaway is this: funding should serve your business, not the other way around. Choose the model that aligns with your vision, your pace, and your values. Build smart, fund wisely, and remember that control is one of your most valuable assets. With the right strategy, alternative funding can turn your vision into a reality on your own terms.